Financial crashes did not begin with Wall Street. Long before index funds, pensions, crypto, buy-to-let property, meme stocks, or house prices, people were already making the same money mistakes, borrowing too much, trusting the wrong people, and assuming that good times would last forever. So, how did smart people lose everything, chasing easy money in the South Sea bubble? The answer is simple. They believed a rising price was proof of a good investment. They saw rich people getting richer, politicians getting involved, respectable names buying shares, and ordinary people suddenly talking like financial geniuses. And instead of asking, what is this actually worth? They asked the much more dangerous question, how do I get in before it goes higher? That question has ruined people for centuries. And in 1720, it helped create one of Britain's most famous financial disasters, the South Sea Bubble. The people caught up in this were not all fools. Some were intelligent, some were educated, some were wealthy, some were connected, some probably thought they were being cautious. And that is what makes the story useful. Because the danger in a bubble is not that it only tricks stupid people. The danger is that it makes smart people feel stupid for being careful. It makes patience feel like laziness. It makes saving feel boring. It makes sensible investing feel like missing out. And once enough people around you appear to be getting rich, your brain starts doing something very dangerous. It starts rewriting risk as opportunity. To understand the South Sea Bubble, we need to go back to a world that feels strange, but emotionally is very familiar. Britain in the early 1700s was not a modern financial society, but it was already deeply tangled in debt, trade, empire, politics, and speculation. Governments borrowed money to fight wars. Merchants borrowed money to fund voyages. Investors bought promises about future profits from distant places they would never see. And this was not even new. Ancient societies had debt. Temples acted like lenders. Farmers borrowed grain before harvests. City-states borrowed to fund wars. Traders used maritime loans to finance dangerous journeys across the sea. Imagine being a merchant thousands of years ago. You load a ship with goods. You borrow money to pay for the cargo. If the ship returns safely, you might make a fortune. If it sinks, you might be ruined. That is finance in its rawest form. Risk today in exchange for possible reward tomorrow. But over time, finance became more abstract. Instead of investing in a ship you could see, people invested in companies, charters, monopolies, government promises, and rumors. And the more abstract money becomes, the easier it is for imagination to take over. The South Sea Company was founded in 1711. Its public story was exciting. Trade with Spanish America, access to distant markets, enormous future profits. The name itself sounded exotic. South Sea made people imagine treasure, ships, sugar, silver, gold, and trade routes full of possibility. But the more important part of the story was less glamorous. The company became tied to British government debt. In simple terms, Britain had borrowed a lot of money, and the South Sea Company offered a financial scheme to help manage that debt. Holders of government debt could exchange it for shares in the company. That sounds dry. Government debt, share conversions, parliamentary deals. But bubbles often begin in boring paperwork and end in public madness. Because once people started believing the company's shares would keep rising, the details mattered less than the feeling. And the feeling was, this is easy money. Picture a London coffee house in 1720. No phones, no trading apps, no financial influencers filming in rented sports cars. Just men in wigs, merchants, lawyers, aristocrats, gossip, newspapers, handwritten notes, and people leaning across tables whispering prices. Someone says, South Sea shares have gone up again. Someone else says, my cousin bought last month and has already made more than I earn in a year. A cautious man says, but what does the company actually produce? And the table goes quiet for half a second. Then someone laughs. Produce? My dear fellow, you're missing the point. That is the sound of a bubble forming, not when people become optimistic, when they become impatient with anyone who asks basic questions. And here's where the story gets painfully modern. The South Sea bubble was not just about greed. It was about social pressure. Because nothing makes you question your life choices faster than watching someone you secretly think is less careful than you make more money than you. That is when people stop investing from a plan and start investing from embarrassment. They buy because they feel behind. They borrow because they feel late. They ignore doubts because doubt feels expensive. And in 1720, that emotional pressure spread through Britain. South Sea shares rose dramatically. The price climbed and climbed. People who bought early looked brilliant. People who stayed out looked timid. And as the price rose, the rising price itself became the advertisement. This is one of the oldest tricks in finance. A thing goes up, so people think it must be good. More people buy, so it goes up more. Then the next buyer says, well, everyone else can't be wrong. But yes, everyone else can be wrong. That is exactly what a bubble is. Every crash has its own costume. In one era, it wears the costume of overseas trade. In another, railways. Then property. Then internet stocks. Then crypto. Then whatever comes next with a shiny pitch deck and a confident person saying, this time is different. But underneath the costume, the emotional ingredients are usually the same. First, greed. Not cartoon greed. Not evil, villain greed. Normal, human greed. The kind that says, I work hard. Why shouldn't I get ahead too? The kind that starts as hope. Second, fear. At the beginning, it is fear of missing out. Later, it becomes fear of losing everything. Same market, same person, different emotion. Third, debt. Debt feels manageable when prices rise. A loan feels clever when your investment is going up. But debt has a cruel personality. It is quiet during the party and loud during the hangover. Fourth, people confuse luck with intelligence. This may be the most dangerous part. In a boom, people who were early often think they were wise. Some were, but some were just early. And being early in a bubble can make someone sound like a genius right up until the music stops. Bubbles do not just attack your bank balance. They attack your identity. They make you feel like a loser for being sensible. And that brings us to the brutal lesson of the South Sea bubble. The market can stay irrational long enough to make cautious people feel stupid, and then turn around fast enough to make reckless people broke. By late 1720, the excitement began to collapse. People who had bought shares expecting easy gains suddenly discovered that prices do not rise just because people need them to. Confidence cracked. Selling began. And once everyone realized the exit door was smaller than the crowd, the mood changed completely. The same people who once said, you have to get in, were now saying, you have to get out. But by then it was too late for many investors. Some had bought near the top. Some had borrowed to buy. Some had tied their future to one decision. And when the price fell, it did not just reduce their wealth. It exposed the truth. They had not bought safety. They had bought a story. So what does this have to do with early retirement? Everything. Because early retirement is not really about finding one magical investment. It is about becoming hard to knock over. That sounds less exciting than doubling your money overnight, but it is much more powerful. To retire early, you do not need to predict the next crash. You need to build a life that can survive one. That means lower fixed costs. Because the lower your monthly commitments, the less fragile you are. If your lifestyle needs everything to go perfectly, you are not free. You are balanced on a chair with one leg. It means avoiding lifestyle inflation. When your income rises, the temptation is to upgrade everything. The car, the house, the holidays, the subscriptions, the little treats that somehow become permanent bills. But if every pay rise gets absorbed by a more expensive life, you are not getting richer. You are just giving your future self a harder job. It means keeping an emergency fund. Not because cash is exciting. Cash is not exciting. That is the point. Cash is emotional armor. It gives you options when life becomes inconvenient, which it absolutely will. It means investing boringly and consistently. Not because boring always wins quickly. It does not. Boring often looks slow. But boring has a gift. It is repeatable. You can keep doing it when the news is scary. You can keep doing it when other people are bragging. You can keep doing it when you are tired. And it means not letting one asset, one job, one trend, or one decision control your future. The person who goes all in may look brave. Sometimes they are just fragile with confidence. Here's the sentence I wish more people heard before they made big money decisions. If one decision can make you rich, it can probably also make you poor. That does not mean never take risks. It means do not confuse concentration with courage. There is a difference between taking a calculated risk and handing your future to one outcome. The South Sea investors did not all lose because they wanted a better life. Wanting a better life is not the problem. The problem occurs when the desire for a better life becomes so urgent that you stop asking basic questions. What am I buying? What is it worth? What happens if I am wrong? Can I survive if this falls by half? Am I investing because this fits my plan, or because I feel embarrassed watching other people get rich? That last question is painful, but it is useful, because many bad financial decisions begin with the sentence, I just don't want to miss out. So let's bring this back to you. You are not behind because you did not get rich during the last boom. You are not stupid because you missed a stock, a coin, a property deal, or some trend that everyone now talks about, as if it was obvious. It was not obvious. It only feels obvious afterwards because hindsight is a professional liar. Most people who chase every boom end up emotionally exhausted. They are always watching charts, always comparing themselves, always wondering if they should sell, buy, switch, double down, or start again. That is not freedom. That is anxiety with a spreadsheet. The goal is not to win one exciting bet. The goal is to become hard to knock over. Hard to knock over means your bills are manageable. Hard to knock over means you are not dependent on impressing people. Hard to knock over means you have savings. Hard to knock over means your investments are diversified. Hard to knock over means you can be patient without feeling ashamed. Because patience is not weakness. Patience is how you stop other people's panic from becoming your emergency. The South Sea bubble matters because it proves something uncomfortable about human nature. We can change the technology, we can change the markets, we can change the language, but the emotional pattern keeps coming back. Greed when everyone else seems to be getting rich. Fear when prices fall. Debt that looked harmless until conditions changed. And people confusing luck with intelligence. So the lesson is not never invest. The lesson is never let excitement replace judgment. Build wealth slowly enough that you understand it. Build your life cheaply enough that you can breathe. Build your future broadly enough that one bad decision cannot destroy it. Because easy money has a cost. And sometimes the cost is everything. If you are working toward financial independence or early retirement, remember this. You do not need to predict the next bubble. You just need to make sure you are not depending on one.